Howdy, Jacob here. Today looking at Edgewell Personal Care in the personal care products industry, 1.7 billion market cap, 2.8 billion enterprise value. They manufacture and market personal care products worldwide. Founded in 1772. Whoa, that is old. So, as expected, with a company that's been around for almost 2.5 centuries, over 2.5 centuries, pardon my language, we are seeing revenue decline, actually. So negative revenue growth from 10 years ago. But the last 3 years have been positive. So maybe there's some looking up. Maybe they sold off some assets to try to be more efficient. And we're not seeing that. Gross margin went down. Operating margin went down. Pay a dividend the last 3 years, but nothing substantial. Return on invested capital and return on equity, very poor. Mid-single digits. Balance sheet has 216 million cash on hand, 20 million short-term debt, 1.4 billion long-term debt. I do like that long-term debt is down fairly substantially, maybe 30% or so, 40% from 2013. But with a company this old, I mean, they shouldn't be running off of any debt and just be using all the capital they have to give back to shareholders. And we're seeing kind of that, a dividend that pays out maybe 15, 20% of capital allocation, with a heavy amount going to share repurchases. Also some large net acquisitions over here. So that's enough to make me ready to make some assumptions. With net acquisitions, I think they'll be able to grow with inflation. I think there's going to be some movement outside with competition decreasing, but I think with maybe 20 to 40% capital allocation assumption to acquisitions, I'm comfortable with that. Let's assume maybe 6 and 7% for margin, 1% of share repurchases, about 17 million. 3% then would be 58, 51 million to offset that, 61, 71, almost $80 million. I think that's fair. It's going to be about 50% capital allocation for 3%, 50 to 60% capital allocation for 3%. And that leaves a little bit for this dividend, which I'm not going to really change since they haven't changed it the last 3 years. So that dividend payout is going to go down slightly, leaving more room for share purchases as the share price goes up, and then acquisitions if an acquisition makes sense. I think they do not deserve the same premium as the market, given the amount of debt they have on hand and given their growth rate. And so I'm going to put them at a 12p price to free cash flow, which may seem low, but again, we're not looking at a lot of growth here, and they have a lot of debt. So I'm going to even put it at 11. So for me right now, it needs to fall 40%. We're fairly close. I mean, if we can be comfortable with these assumptions, needing to fall in half, companies' stock prices do that all the time. And so this could be interesting. We just got to be comfortable with these margins, be comfortable with this revenue growth. And then I think you're looking at, I mean, maybe I was being a bit generous with some of this. So, I mean, if I do 2% revenue growth, now let me go back. 3% revenue growth. This is assuming, what did I say? 20 to 40% acquisition. Let's say 20%. This is 50%, 70%, 10. I guess that leaves just 20% for debt reduction, which, I mean, given their age, I think I'm fine with that. I mean, they are consistently, at least historically, the last 10 years, buying shares down. So, okay, just kind of walk through some things, but I feel comfortable with these assumptions. So, still needing to fall 40% before we get the return I'm looking for you. Hope you enjoy the video.